The Bank of Russia today opted to hold key rates for a 10th month in a row at 8.25%. Christopher Granville of Trusted Sources joins me on the phone now to discuss this further. Christopher, markets had been split on whether the central bank would choose to cut rates or not. In your view, what was the deciding factor in central bank thinking today?
Well, I think that although, as always with market predictions, there were people predicting both a rate cut and what has actually happened, which is the Russian central bank staying on hold, in my view, the consensus was definitely expecting a cut in rates, given weak growth performance in the Russian economy so far this year, and some indicators getting weaker in the recent month or two. So it's quite interesting that the Russian Central Bank, under its new governor, Elvira Nabiullina, this is only her second monthly interest rate setting decision over which she presided, has chosen to keep rates on hold. And my reading is that the credibility of the new inflation targeting framework in Russia is paramount. And the central bank is saying, never mind about economic weakness, our target range for inflation is 5 to 6%. For annualized CPI, we're still at 6.5%. We are serious. We want to be credible. We're going to keep driving inflation down. In their accompanying statement, which they put out as the interest rate hold decision was announced, the key sentence is that they want to, as a reference to bearing down on inflationary expectations, locking in lower expectations. So this is, I think, quite impressive. It's good for credibility, and they're ready to live with lower growth for the time being.
You mentioned their inflation fears, which do remain a key priority to the Bank of Russia, as you mentioned, with inflation data released on Monday highlighting that consumer prices remain above target. The key question is whether the central bank's policy of inflation targeting is working, or should the markets be adopting a more of a wait-and-see policy?
Well, I think that the reason why, as I mentioned just now, the consensus expectation was probably for a rate cut today, which did not happen, is that although headline inflation is still above target in July, as you say, 6.5%, the direction of inflation is firmly downwards. We have a very strong favorable base effect. So this time a year ago, the second half of 2012, inflation was picking up. The harvest in Russia this year is clearly going to be a lot better than last year's very weak harvest, and this will put further downward pressure on food prices. So I think markets were sensing that although the headline rate is above target, it's coming down, and therefore the priority would be now for growth. But just to repeat, what's interesting about today's decision is that they're going all out for credibility. They take the target seriously and clamping down on inflationary expectations.
Annual GDP data has today come in at a lower than previously 1.2%. While this figure, the first acceleration in 6 quarters, does suggest an improvement in domestic demand, what are the remaining downward pressures on the Russian economy?
Well, it's above all weak demand from Europe. The European recession has hit Russia quite hard. Although oil prices have remained quite healthy, the European gas market, which is very important for Russia, has been extremely weak for the last 2 years, and that's probably now bottoming out. But European demand for steel, bulk chemicals, and other exports, including now Asian demand as well, has been weak, and this has filtered through into weak domestic demand as well. So these are the factors which are causing the slowdown in economic growth in Russia, as in many other emerging markets, of course. But the good news is that probably we're bumping along the bottom, as you said, Natalie. And I would draw attention to one particular feature which I think is extremely encouraging. The downward trend of inflation is continuing despite the exchange rate of the Russian ruble depreciating since the last couple of months, since May. Now, this is actually a very favorable combination for Russia. Often, when you get exchange rate depreciation, you get higher inflation because the cost of imports goes up. but the depreciation has coincided with strong disinflationary pressure. So Russia is going to enjoy the best of both worlds. Its exporters, starting with oil and gas and other natural resource exporters, will be more profitable with the weaker exchange rate, and inflation is still coming down because of underlying structural disinflationary pressures. So that's actually quite encouraging for growth.
And lastly then, Christopher, with indications that the central bank will be looking to shift towards a looser policy stance in the coming months, what can we expect from the Russian ruble in the short, mid and long-term period?
Well, just to continue from the previous point, the ruble depreciation, which I mentioned since May, of course, has been in line with global developments. There's been a broad sell-off in pretty well all emerging market currencies. Now, exactly as you say, although the central bank slightly unexpectedly stayed on hold today in Moscow, clearly there is scope for rate cuts. They will come, if not next month, I think it's quite likely, but certainly by the end of the year. Then continued mild depreciation of the ruble is going to be expected, and as long as this is no sign of showing any inflationary pressure, I don't think this is going to get in the way of further rate cuts. So let's contrast the situation, say, with India, another big emerging market. There, the central bank is tightening liquidity conditions to try to defend the currency. I don't see the same happening in Russia. So a relatively benign outlook of mild depreciation, continued falling inflation, and growth just picking up off the bottom now, which we've seen in the last few months.
Christopher, many thanks for your comments. Want to hear more exclusive interviews with industry leaders across a plethora of FX and macro topics? Well, stay tuned to Dukascopy TV.